Hello and welcome back. Joining me this evening from Bali. Listen, it's been a decent week in the markets. We're currently up 5.4% over the last 7 days, still riding the wave of that historic Fed rate cut decision last week and an institutional bid which has seen net inflows into the spot Bitcoin ETFs over the last 5 consecutive days. That being said, I think there is reason to be very cautious going into the next couple of days and the next couple of weeks of trading. Let me get right into why I think that is, and hopefully we can all come out the other side of this in the green. Hello and welcome back. First of all, apologies for my negativity and my FUD in the intro. The thing is, history has proven time and again that it pays to be cautious in markets like this. What do I mean by markets like this? Well, in case you haven't noticed, we haven't been terribly bullish over the last couple of months. And we do in fact remain in a downtrend on those timeframes. A couple of years ago when the bull market was raging, it made a lot more sense to throw caution to the wind in many circumstances and hold on to trades to the upside and get excited about small moves and small breaks of key levels to the upside. The time for that is not right now, and I'm going to go into a little bit more detail on that in just a second. First of all, though, let's review the last couple of days in the market. And it's been a decent couple of days in the market, up 5.4% over the last 7 days, still riding the wave of that surprise 0.5% rate cut by the Fed. Why is that bullish? Well, investors can get less money for holding on to yield-bearing assets, things like bonds, and therefore capital flows from those assets into so-called risk assets, things like equities, i.e. stocks, and Bitcoin, crypto as a whole. Let's jump into the charts and have a look at where we are right now. I'm actually going to start by bringing up the S&P 500 chart here to illustrate the point that I just made. And essentially, we've just been pressing up since we broke all-time highs after that Fed rate cut decision last week. Let's go over and look at Bitcoin. And as you can see, we've just clipped that key 65K level to the upside. Over the last couple of days, we've been floating around, playing ping pong basically between that 65K level and the lows down here at 62.4. We're yet to come back down and test the former resistance at 61,200. It's interesting to observe that these last couple of rejections from that 65K level have pretty much played out like for like. One on the 23rd of September and the second one on the 24th of September. Obviously, we're yet to see what this next test of 65K does, but the point still stands. 65K is the next really key level to the upside, and acceptance of that level would basically turn us into a technical uptrend from the low put in on the 5th of August back here. So to expand on the bull case, let's look at some news. First of all, PayPal is set to allow businesses to transact in crypto, buy and sell crypto, and transfer it between accounts. Of course, PayPal's been involved in the game for a little while, launching their stablecoin back in August 2023. I tweeted this, by the way. Go and follow me on Twitter if you feel like it. It's at Tom Butler Crypto, the same as my YouTube handle. Appreciate the support. Why is PayPal allowing businesses to trade in and transact in crypto important? Well, it plays into institutional adoption. When we talk about institutions in crypto, we're talking about two main things. The first is institutions investing in crypto via instruments such as the spot ETFs, driving price up because there's just more demand there, basically. Institutions have more money than retail traders have, and therefore their effect on markets is much greater. We're also talking about adoption by companies like PayPal starting to use crypto for day-to-day business operational tasks. This basically just expands the ecosystem because we're moving closer and closer to a vision of a future financial system where value is transacted by digital assets versus the historic fiat systems of the past. Prices go up, the market expands. We have also got Bitcoin live on the Vegas sphere. Now, this may seem like something of a novelty right now, but this plays back into the point I was making earlier in the video that you have to be mindful of where we are in the market cycles in order to make money in these markets, right? Even a couple of years ago, a news release like this would have been market moving. Now, of course, this is still more bullish than had this not happened, but right now where we find ourselves in the markets, this isn't really that big of a deal. Next, a tweet from John Bollinger, who developed the popular, or at least famous, trading indicator, the Bollinger Bands. He's saying we're printing a bullish W formation on the weekly BTC USD chart. As ever, markets don't move directly because of lines drawn on a chart, but always interesting to take a number of different perspectives, particularly from a master of the game, if you like, as we find in Mr. John Bollinger. And then finally, back to institutional investment via the spot Bitcoin ETFs. So the BlackRock spot Bitcoin ETFs saw net inflows of $184 million yesterday. That is the 25th of September. Yesterday overall for the entire spot ETF market was a $105.9 million inflow day. And that was actually the 5th consecutive day of net inflows over the last week. BlackRock really pulling the weight of yesterday's inflows and turning the day to a positive inflow day despite Fidelity and ARK both dumping $33.2 million and $47.4 million worth of outflows each respectively. The BlackRock IBIT iShares Bitcoin Trust ETF remaining the largest on the market by assets under management by a significant margin, followed by the Grayscale Bitcoin Trust. So we're up 5.4% over the last 7 days. We are currently, right now at the time of recording, challenging key resistance at $65,000. There is a hefty institutional bid coming into the market, at least via the BlackRock Spot ETF. The stock market's still up, and Bitcoin was featured on the Vegas Sphere. So why am I cautious? Well, aside from the points I made in the last video about my skepticism of the Fed's decision to cut rates so aggressively this early in the cycle, that kind of remains a long-term concern. I'm also concerned in the short term, and that relates to two key metrics of the market: the market sentiment as measured by the Fear and Greed Index, and the pretty closely related liquidations lurking in the market. So let's take a look at those two metrics right now, and I can explain to you exactly what I mean by that. Fear and Greed Index currently sitting perfectly neutral at 50. What I want to draw your attention to though is that yesterday, just yesterday, we were sitting in greed at 59 out of 100. Before that, obviously averaged out at slightly lower than neutral in slight fear. The problem I have with this is not the fact that we're at neutral, but the fact that we have flipped so hard from yesterday so soon, right? In just the time of a day. And this relates back to what I said at the start of the video, which is that now is not the time for us to get really, really excited about a very small move to the upside. So of course, there is a little bit of a lag in fear and greed numbers, and this is kind of an abstract concept anyway, given that that is fundamentally a subjective measure. But look at how we've been flip-flopping, right, between this 62.5 level and this 65K level. What I'm seeing here in conjunction with the fear and greed index is that we come up to this level, everyone gets excited, then we reject by just a couple of $1,000s, and suddenly everyone's in fear again. This doesn't point to a terribly bullish sentiment to me. That means the market is very, very fickle at the moment. It's very easy for the market to get euphoric on a small move, and it's very easy for the market to get scared on a small move to the downside. If we corroborate that sentiment with the amount of leverage in the market, and specifically where that leverage is positioned, where it might become liquidated, we start to see the real essence of my concerns that things might get quite dramatic to the downside. So to the upside at around $66,800, short positions that would be liquidated to the upside total around just shy of $1 billion. And at the nearer level, down at $65,600, that is closer to around $300 million of short positions that would be liquidated, i.e. forced to buy into the market at those levels. If we look down to this consolidation area that we've been in over the last couple of days, around about $62,300 is the line in the sand that we've drawn the chart here, the bottom support of that range. So $62,300 on the liquidation map represents about $2.2 billion worth of long positions that would be liquidated, i.e. forced to sell if price was to fall below that point. If we look down a little bit further here at around $60,600, that number jumps up to nearly $3 billion worth of long positions that would all be forced to sell and liquidated out of the market if price was to fall that low. So to summarize, even as we have currently broken key resistance at $65,000 and come on to challenge the next key resistance at $65,600, if we were to reject that, come back within range and come back to test the bottom side of the range, any breakthrough this 62,300 level could be over-exaggerated to the downside and result in an overextension. That for me would represent an excellent buying opportunity as we come back down into this sort of liquidity area down here at around $60,000. So speaking of liquidity, let's corroborate what we just looked at with what the order book is saying. So right now using Bookmap, I'm looking at the liquidity in Binance futures, and what I'm seeing from this chart is liquidity is just more thickly packed to the upside than it is to the downside, right? There's sell side liquidity all the way up from where we are right now to around about $66,700. That is, by the way, pretty much in line with this next point of resistance that we pointed out on the chart, 66.8. To the downside, the order book is looking much more thin, a bit of a spike down here at around 64.5, and then beneath that, very little. So in essence, a lot more sell orders are placed in the book above where we are right now than there are buy orders in the book below where we are right now. Once again, these are the markets by nature. They are not predictable. From here, we could see a load of fresh liquidity come into the market. We could see sentiment shift totally. If we take on some of these higher highs, maybe we stay up here. Maybe we start breaking out of the downtrend, and maybe we take on new all-time highs soon. But for the reasons that I just outlined, the sentiment in the markets, how the liquidity is stacked up in the books, and where key points of liquidations are, i.e. at the bottom of this little range down at $62,300, I can totally see a situation arising where we spike up into liquidity here, get rejected, and then come down to liquidate some of those longs that have piled in right now, as we should all try to avoid doing, jumping in on the hype, jumping in on the euphoria as we break out, jumping in with too much leverage, and then getting liquidated to the downside as the market rips down through all those stop orders that are standing in the book. That for me would represent a very exciting buying opportunity to get into the market down at that $60,000 range. That being said, thank you so much for watching, but none of this should be considered financial advice. I am just looking at the market for entertainment purposes only. Plenty more to come. Catch you in the next one. Cheers. Bye-bye.